Hello, this is Mike Swanson of Wall Street Window. I got a trade I just did today that I want to talk with you about. It's a small trade. I'm not trading big right now. I'm not doing big positions. I've got big cash reserves, frankly, because I think uh, this is still a market to trade small, not to take big risks. You saw what the stock market has done up until about 5 weeks ago when we finally got a relief rally. I do think the stock market can hang in there a couple more weeks. I think the rally can continue. Whether it's going to be the start of a big bull market, I think it's highly questionable and should not be taken as a given at all. I did a previous video about what to look for, what resistance levels to watch. This video, I'm going to have an additional thing to watch because I think bonds are going to go down before the stock market really goes down or this rally really tips over. That's how this bear market started for stocks. The bond market peaked out in the middle of last summer, and bonds slowly started to go down before the stock market did. And I just took a trade against the bond market. I think Treasury bonds, they've had a relief rally and are now overbought. But I think in the long term, bonds are actually in a worse position than stocks are as an investment. You see, bonds began a secular bear market last year. That a secular trend is a long-term trend. It's not just a couple months. It's not just a year or two. It's like a decade out. And I think it's a serious situation. Why do I say such a long-term trend? Well, you have to understand that bonds trade opposite to bond yields. And so when interest rates go down, bonds go up in value, but when rates go up, bonds go down. That's why this year has been such a difficult year for the traditional 60-40 portfolio with like 60% in stocks, 40% in bonds. Historically, when the stock market would go down, bonds would go up. And that would help mitigate risks and actually help boost performance in the long run in that classic investing strategy. Now, if you back test it from before 1980, it was a bad strategy in the 1970s, and it's been a bad strategy this year, although the past 5 weeks or so has seen both stocks and bonds go up. But I think the rally in bonds really doesn't have much more upside, even if the stock market continued to go higher. And I think bonds will go down first before the stock market would tip back down again. That's what happened last year, as I mentioned. Now, the problem with bonds from a long-term perspective isn't simply inflation. It's the simple fact that in 2020, interest rates went to zero. And it wasn't just the United States, it was all over the world that interest rates are lowered. But when rates went to zero, they had nowhere else to go. And that pushed the value of bond funds to a height that's really unprecedented. And it's a secular peak. And they've been slowly going down ever since. Bonds aren't as volatile as stocks, so people don't pay as much attention in their portfolios to what bond funds do to what stocks do. And some stock funds are highly volatile, such as the ARK ETF that Kathy Wood manages, and some stock sectors can be highly volatile too. And so are other asset classes for that matter. Bonds are supposed to be less volatile. Now, let's look at a chart and then why people aren't really, I don't think, thinking correctly about this recent bond rally. And I'll show you exactly what I got to load up my screen, share my screen with you, what it is that I got into here. So this is the TLT exchange traded fund. It tracks the 20-year treasury bond, and it's been in a bear market this year. And I define a bear market as something trading below the 150-day and 200-day moving average, not just for a week or two, but for months. And TLT is doing that. And in a bear market, those moving averages typically act as long-term resistance levels. In bull markets, the opposite happens. They act as long-term support levels. And classically in the stock market, you get a 10% decline in a bull market to those moving averages, which makes for a wonderful buying opportunity. And we're still actually below them. But with the bond market, I think this is a temporary rally, and people are overplaying how long I think it will continue. Now, I can be wrong, and that's why this is a small trade for me, and I'll get out, take a small loss. But I think this, if I'm correct, this will be a position I might be holding for the rest of the year, the short position I got against bonds. Now, we're overbought on the slow stochastics indicator, tapping above 80, and we had a nice reversal today. And the funny thing is, bonds are typically safety trades, right? When the stock market drops, there's scares, people put money in bonds. Well, today we had global tensions increase with the Pelosi trip to China and statements on both sides, but bonds didn't get a bid on that. That's a bearish signal. And I think it's a sign that the bond rally is likely peaking out. Now, what I did is I bought TBT, which is a short ETF that's designed to go up when TLT goes down. I bought a small position in my main portfolio. I put it in that model portfolio on tip ranks that I've been using too. And I'll put a link to that with the video. But look, I have a mental stop loss below 22. It's just a trade. We'll see how it plays out. I think we should make new highs on this before the end of the year. It's not a trade. I'm trying to day trade this. It's to hold into the end of the year. And let's see if I can make some money on this trade. Now, here's the thing where I think people are misunderstanding what's going on. There's so much talk of a Fed pivot now in the alternative financial media, in the mainstream financial media. And people have this belief that, the Fed's going to stop raising interest rates, or the Fed's going to pivot and cut soon, so stocks are going to go up. And the experience people have had in the markets for decades is that when the stock market would drop, the Fed would lower rates and the stock market would go up eventually. And this has been the experience. Well, it didn't really work that well in 2008 and 2000. The Fed would lower rates, the stock market, didn't stop the bear market. But that has been the story since 2009. In 2011, there was a flash crash, and within months, Ben Bernanke announced a QE operation. 2012, same thing happened. There was a crisis global debt crisis in Greece. Within months, expansive QE. In 2016, there was a 20% decline in global markets, a new QE operation. In 2018, 2017, the Fed started to raise interest rates. And in 2018, they started to talk a little bit more aggressive about it. In the fall, the stock market slid 20%. By December of 2018, the Treasury Secretary Mnuchin said he was alarmed. And then within a week or two, the Fed said, we're not really going to raise rates. We're suspending the rate operations. And then within a few months, they began to actually lower rates. And the stock market, upon that announcement in December, made a bottom, and there was a tremendous rally. And then in 2020, the stock market got smashed with the shutdown announcements. S&P, melted down over 30% in just a few weeks, and the Fed lowered rates to zero. And of course, we had the tremendous rally after that lasted into New Year's for the NASDAQ and the S&P 500. So people have these memories that this is what's going to happen. We've seen stock market weakness, some talk of a recession. So the Fed's pivoting, and stocks are just going to go to the moon. But I don't think this is the case. I don't think the Fed's about to lower interest rates at all. So instead, I think we're overshooting the bond rally, and the stock market rally can continue a little bit more on some momentum. It's August. It's a thinly traded month, but we'll see. And again, I as a trader, I look at the market situation every single week. I'm willing to change my mind and adapt and adjust. To me, it's not so much about predicting the future, but it's trying to identify potential changes in the trend. We're in a short-term uptrend in the market, which I believe is in a bear market. We're still below the 200-day moving averages, and I think that the bond rally, though, is going to peak out first. And I think it's probably peaking out already. So that's why I took a small trade today in TBT. And unfortunately, the US dollar, it's pulled back too. It's up today. And gold is also down a little bit. Let's see, what's gold down exactly? $10. Gold got up to 1790. Now it's at 1760. I'm not, how should I put this? I think the rally we've seen in the past 10 days or so in gold has probably lost its steam now. We'll just have to see how that plays out. But my favorite indicator for gold is the GDX divided by gold ratio indicator. I talked about that in a video 2 weeks ago. And the GDX is down 1.28%. This doesn't really look like it's bounced much at all. And the action in GDX tends to lead the action in gold in the mining in gold. And the GDX divided by GLD ratio, it's hardly bounced at all. So I think, I wouldn't be too excited about gold either right now. And I think that's also a sign that that's things are being overplayed, in the markets. I'm not saying gold's going to crash. We could just be going sideways in a trend, but I think short term, the rally steam is probably peaking out, just as I think it is more than probably peaking out for bonds. I think bonds could make a new low. Inflation's not going away, folks. Yes, I do think, this annualized 9% CPI, it could very likely be the peak of inflation for now, probably for the rest of the year. The number is probably going to come back down to 7, 6, 5, but that's not the end of inflation. And interest rates are still low compared to the rate of inflation. So there's no reason to get excited about bonds. I think it's overplayed. I think people are overestimating the Fed lowering rates. In fact, the Fed itself, in statements made early in July, said, Jerome Powell, this is, and other Fed officials said that they do not want to be lowering rates anytime soon until they see true evidence that inflation is dissipating, or else they'll be repeating the mistakes of the 1970s when they lowered rates, in their view, too quickly in 1974, and then inflation just exploded again. They don't want that to happen. That would be a complete debacle for the economy, and even a worse situation for the stock market than what is taking place so far this year. So the stock market volatility, the turmoil in the markets is not over. I don't believe. I think this is still an extremely difficult market environment to be making money in. It doesn't mean we can't be making trades. I just made one today, and I'm sharing it with you in this video. To get more market views, updates from me, click the subscribe button and click the bell. In fact, you're going to want to do that because the next video, I'm going to put out the most single profitable trading pattern I've ever used, ever. It's going to be in the next video. You're going to want to get that. Going to put out tomorrow afternoon around 2 o'clock. Click the bell, click subscribe. You got to click subscribe first, then the bell, and you'll get that video, and I'll be talking with you later.